It's Market Call, and our guest is talking real estate. It's Andrew Moffs of Vision Capital, 1-855-326-6266. Andrew taking questions on real estate stocks. And Andrew, can I clarify with you, you're happy with REITs as well as equities that play the property market?
Indeed.
Okay. You are paying attention to inflation, and of course, one of the advantages traditionally of buying real estate was inflation protection. But you think that this inflation will play out differently for different real estate sectors?
Correct. Yeah. So generally speaking, real estate is a great hedge for inflation. It's a real asset. As inflation goes up, rents go up, and of course, then the real estate itself goes up in value. But you have to be careful, asset class by asset class. It would be a misnomer to think that all real estate should capture inflation. And if you look at the environment today, what the pandemic has done is only exacerbated certain forces. So, for example, when you have office space at record vacancies, you're not going to be able to capture inflation to the same respect as industrial, which has record low vacancies. So we think a strategy where you go top down by asset class, and the asset classes that are strong, think about single family rental in the United States, think about industrial warehouse like I just talked about, and tend to avoid general merchandise, enclosed malls, office. You're probably better off in the inflation cycle this time around.
And Andrew, you have an interesting point about U.S. President Joe Biden's massive infrastructure plan or budget proposal. It does involve corporate tax increases, but you say for REITs with U.S. exposure, they generally are not as vulnerable to increases in taxes because they're flow-through entities.
Correct. That's the beauty of REITs. They don't pay taxes at the corporate level because they have to, by law, pay out all their income as distributions or dividends, or at least 90% of the income. Thus, when it comes to changing corporate tax rates, you think about it, REITs are almost agnostic. It's not going to affect the level of dividends or distributions they're going to pay. So for that group of investors that really care about the yield, they won't suffer in any respect. And so we think on a net basis, REITs should actually be better off than many corporates that are paying yields today.
Well, let's take a break and get to your questions for Andrew Moffs. He is in the market for queries on REITs and real estate stocks, 1-855-326-6266, or you can email him, marketcall@bnnbloomberg.ca. We have an email from Boyd. Boyd is curious about Slate Grocery REIT, SGR. What's your take on this one?
Slate's a smaller cap REIT focused exclusively on assets in the U.S. that operate grocery anchored shopping centers. Generally speaking, we like that sector, grocery anchored. It's through the pandemic, it's proved its resilience in terms of cash flows. This particular REIT right now is fairly valued. They just did a strategic acquisition of a big portfolio in the United States at a pretty competitive cap rate, high 7% cap rate. And again, a cap rate is the going in yield for any asset. So the higher the yield, the cheaper, the lower the yield, the more expensive. So they've done a good job of expanding the portfolio. It's a high yielding stock. As a result, we actually look, when you analyze the rents versus distribution, I don't think they're covering the distribution today. So I'd say it's a sector I like. I think there's probably better value elsewhere in the sector, and we can talk about that a little later in the show.
Okay, we have a question in similar vein. Brent is asking about Smart Centers REIT.
So Smart Centers is a great company. Operates large open air centers across Canada with a particular focus on Walmart anchored centers. So this is, think about necessity again there in terms of general merchandise. However, there isn't necessarily a grocery component. When I look at Smart, it's done a great job of rallying off the bottom this year. A lot of that value is gone. And today it trades pretty much at parity with net asset value. And then when I think about on a go-forward basis, when I look at the earnings profile of Smart Centers versus the other opportunities available, say a First Capital REIT, for example, Smart actually has the lowest earnings growth amongst its peers, and so it's generally a stock we're not looking to own today.
Okay, just remind us, a retail player, are they fairly defensive in the sense that their clients, that's the Walmart REIT, isn't it?
Correct, yeah. So defensive, the cash flow is solid, hence you can feel very comfortable owning that distribution. We of course focus on earnings growth, because as earnings grow, the value of the assets grow, the ability for that distribution to grow continues. You're not necessarily going to see that from a Smart Centers, notwithstanding they have great assets. You're seeing a bit of a muted earnings growth in the short term into medium term.
Robert is standing by in Brantford, Ontario. Go ahead, Robert.
Good afternoon. I'd like to get your thoughts on Choice Properties. Number one, they have a huge partner. Number two, their asset values have soared because of real estate valuations, and I'm not buying the fact that office buildings and shopping malls are the past. What's your thoughts on that? Thank you.
Great. So we really like Choice Properties REIT. We definitely think it's a buy. This stock is heavily weighted towards retail. Its parent company is George Weston Company and Loblaws. Hence, its centers, about 95% of its retail centers are anchored by a grocery store or drugstore in a Shoppers Drug Mart. The necessity-based retail proved its worth throughout the pandemic. If you look at assets trading today in the private market, they're probably going at a premium to where they were prior to the pandemic. That just tells you a bit about how resilient both the cash flow is and how people think of the value of these types of centers. Choice does have an office portfolio. The balance of its portfolio is in office and industrial. But we think what I like about their office concentration, I also agree, office is not dead. It's just going to be used differently. Where Choice benefits is that its typical tenant is a smaller tenant. If you think about who's going to be reducing space going forward, it's those large enterprise type tenants that have have many floors in one office building, for example. That's not the type of asset that Choice owns. So between its growing industrial portfolio, its very solid, long-term, almost net lease portfolio to Loblaws, it's almost bond-like with an investment-grade tenant. We really think Choice is a great combination of safety plus growth. And so I think it's a stock you want to own today.
Safety plus growth, yeah, it's fascinating. Okay, the way both Canadian Tire and Loblaws launch REITs in that sense to capitalize on their real estate. Bob in Medicine Hat, go ahead, please.
Yes, good morning, gentlemen. I'd like to ask about Artis REIT. It's been taken over by Sandpiper, I believe, and they basically stated that the net asset value is in excess of $15, but the stock is trading at $11. Now, do REITs usually trade close to their net asset value? And what is their percentage of U.S. assets? And because the economy is opening up faster in the U.S., will that be a positive or a negative? And of their holdings, how much is office, how much is commercial, and how much is residential? Thank you very much.
Great. No, those are great questions. Artis REIT, you are correct, has been going, they just announced a business transformation plan where an activist investor, Sandpiper, has taken control of that REIT. I'd agree, at least their IFRS valuations have been around $15. That said, in order to capture that value, we think there's quite a bit of tax leakage as a result. I think, as the caller mentioned, the portfolio spans both sides of the border. And anytime you have assets in the United States, there's typically a tax liability that comes with it, let alone the low tax basis they have in certain assets here in Canada. So we think that leakage is up to $2 per unit, which is pretty significant. The portfolio is broken down about, I'd say, half in office, about a third in industrial, 20% in retail. Industrial is a part of the portfolio I like. They're going to be selling that. They're going to then be left with retail and office. But the goal that Sandpiper has laid out is to invest in publicly traded securities. The caller asked, do REITs trade at NAV, premium, discount? Typically, on average, we've seen REITs trade at a premium to NAV. Artis has historically always traded at a discount to NAV. It was a diversified REIT. It wasn't in any particular bucket. I think all this has done is complicated the story. I don't think there's any comp out there that will show you that REITs that then own public securities of other REITs should trade at a premium to NAV. And I think there's considerable conflicts of interest that need to be mitigated here, that need to be thought about if you're going to take an investment in Artis. So all that said, there is quite a bit of value there. I think the sell-side analysts would agree getting from A to B will not be a straight line, and you have to take that volatility into account when you buy a stock like Artis.
So our last two callers were Robert and Bob. So let's go to Rob in London, Ontario. Go ahead.
Oh, hi. I wonder if I get Andrew's views on the Geo Group. Now, I know their stocks tumbled due to some issues with dividend cuts and so forth, but I thought they might have a good business plan with running U.S. prisons.
Yeah, so this is one of two prison REITs in the United States. It's had a long history operating in the U.S., I think over 20 years, related to a group called Wackenhut originally. It's a tough sector to be in. At this time, it's very difficult for, especially from an ESG, environmental, social governance perspective, to make a business case for privately owned prisons. So I think that's where the stock has gotten into trouble just from the market perception, let alone, contracts that are either awarded or taken away. And so the earnings visibility is not there for a company that should really just be a net lease company, owning prisons and leasing them out long term. I think there's a lot of company risk there. There also they might move away from the REIT structure. So I wouldn't want to make a bet today on this company as a steady dividend earner. And I think there's better plays out there if you're looking for just a steady net lease type of company that owns almost infrastructure-like assets long term. I think there's a bit of risk when you're investing in the prison space today.
Let's take a break. Andrew Moffs is taking your questions on real estate stocks and REITs. 1-855-326-6266. Let's head to Vancouver. Paul is on the line. Fire ahead, Paul. I'm not hearing Paul. The question is about Cap REIT, the giant apartment play.
Cap REIT, ticker CAR, we're very bullish on at Vision. This is the largest operator of apartments publicly traded across Canada. It still trades below its pandemic level, pre-pandemic levels. And that kind of makes sense. The market has been a little depressed in terms of the multifamily market in Canada as two factors. One, immigration has paused, and two, foreign students, there's been a question mark as to whether they'd be returning for the fall session. The outlook has brightened with the COVID vaccine rollout. The federal government has, pledged to increase immigration coming next year. Many reports, including I just saw, yesterday, University of Western Ontario intends to have in-person classes. All this bodes well for multifamily demand. Then you look at the valuation of Cap REIT. If I look south of the border, apartment REITs are trading 15-20% premiums to net asset value, and that's in a very challenged market. The Canadian market, notwithstanding some, headwinds in terms of, people moving to Canada and demand for the product, we never saw the dip in occupancy at all in Cap REIT's products. So we're very bullish on its prospects at a time where it trades in and around net asset value, let alone the forward value. So this is a stock you definitely want to own, especially going into next year where we see NOI, net operating income pickup in the early parts of 2022.
Given that getting reasonably priced apartments is such a problem in many parts of Canada, well, notably Vancouver and Toronto, is there any way you think the private sector could be encouraged to build more rental accommodation?
So, it's a great question. The real incentive needs to be on the affordable side because we are seeing purpose-built rental go up. But in order for that to be justified in new construction, you really need something like $4 per square foot in rent. That's not affordable to many Canadians. And so what you need is incentives from either local or provincial or federal government in terms of providing affordable rental product. And you're seeing many projects like that. You know, a previous caller asked about Choice Properties. They're doing an interesting new development here in the Greater Toronto area, downtown Toronto, which will have an affordable component. That's really what's needed. But at this time, there really is no new stock that's being supplied to the market, and hence we think the incumbents, think CAPREIT, are well positioned to take advantage of what is very limited supply and growing demand.
So I'm thinking $4 per square foot per month. So that would mean for a pretty small 700-foot apartment, you'd be paying $2,800 a month rent.
Yeah. So yeah, what you're finding is that in order to make that number work on the monthly payment, the units are getting smaller and smaller. So you have great common area amenities, but you're going to have a much smaller apartment. That's the benefit of some of the older product that has larger space at a cheaper per square foot value.
Wayne is standing by in Meaford. Go ahead, please.
When I called in, I mentioned Brookfield property, but I'm not sure that's what I want info on. I was forced to sell my Genworth MIC, which one of the Brookfield property or Brookfield companies picked up. So I'd like to know which one they rolled it into. They got it at a great bargain price. It was trading close to 60 when the pandemic started, and of course people thought they'd lose money on the mortgages they were insuring, but they didn't, and they were making more money by the time the deal was struck. So do you know which Brookfield they have? And I might buy that one.
Sure. Okay, so because Brookfield, you said, took them private. Is that what you said?
Well, they bought it. I don't know
think
if they rolled it into one of their companies.
Okay, no problem. So he says that Brookfield got a great bargain when they bought Genworth, the mortgage insurer. Any insight there, Andrew?
Well, you know, as a general question for Brookfield, I always find owning Brookfield Asset Manager, ticker BAM, /A in Canada, or on the New York Stock Exchange, BAM. That's probably where you want to look to reinvest your capital. It's a really smart management team doing great deals. They operate many public subsidiaries, including what was Brookfield Property Partners, about to be privatized. But all the cash flows move up to Brookfield Asset Management, and as a world-class investment manager, I think that's where you'd probably want to focus. So, positive, generally speaking, positive on Brookfield Asset Management. And they have a growing fee stream focused on real assets, and that's probably the sector you want to be in over the next 10 years. So that's my short answer for your caller.
Okay. Now, when the deal to buy out the remaining shares of Genworth was announced in October, it was announced by Brookfield Business Partners, BBU in New York, BBU.UN in Toronto. But Brookfield are always mutating their corporate structure, so that could be out of date. That's from late October. Okay, we're going to take a look at Andrew Moffs' past picks. You're watching Market Call. Andrew was on our show June 25th of last year. Tricon Residential was your first idea. Andrew, would you buy this one again?
Yeah, absolutely. We continue to own it. It's actually one of the largest holdings in our fund today. The stock did very well over the past year for a couple of reasons. First of all, the company focuses on residential in the U.S. primarily, and that's really focused on the single-family rental space, where they buy single-family homes and rent them out in an institutional manner. And they also have a multifamily portfolio in the U.S. Sunbelt, and this is all exclusively focused in the U.S. Sunbelt, where you're finding the population moving to. They focus on that mid-tier affordable rent. So if you think about what happened during the pandemic, people were concerned at first, will people pay the rent? Well, they certainly paid the rent because they needed somewhere to live, and their rents were affordable. So if you think what happened throughout the pandemic, Tricon collected all the rents. In fact, the rents went higher, occupancy stayed stable, and they were able to reduce leverage through a few strategic transactions over the past 12 months. That was really the big thing that was holding back Tricon previously, was a higher debt profile. They've now done a great job of reducing debt. And so we think they have a tremendous runway looking ahead in terms of the growth that's inherent in their portfolio.
Your next idea, European residential REIT, big play on Dutch apartments, I think.
That's right. This stock, out of the entire multifamily apartment space globally, this is one of the few stocks that still trades below its pre-pandemic values, and we question why. When you look at its competitors across Europe, they all trade, pretty much at near to all-time highs. You actually just saw two German residential REITs get together at what is over 30 times cash flow, a big merger between Vonovia and Deutsche Wohnen in Germany. ERE trades at just over 21 times cash flow, meaning there's a lot of upside there. This is a stock that operates in the Netherlands. There's a housing shortage in the Netherlands, and yet throughout the pandemic, we've only seen rents go higher. The market's a little concerned about rent control, but what's really interesting to us, this stock is externally managed by Canadian Apartment REIT, who operate with exact same rent control regulations here in Canada to a certain respect. And if you look at ERE, they're going to still show 3 to 4% top line growth this year, despite the fact that rent control is limiting them to CPI plus 1%. So you go back to what we were talking about at the top of the show about inflation. ERE is capturing that inflation. Their cash flows are worth more today than they were a year ago, yet the stock really hasn't moved. So we think there's tremendous upside in ERE, and we continue to own it.
Okay. And then your last idea is, at least in part, a play on the warehouse space crunch in Canada.
Correct. So Granite REIT, it's a stock we continue to own. It's done very well. The industrial thesis was well understood pre-pandemic. As e-commerce as a percentage of retail sales was increasing, so would the need for industrial warehouse space. Throughout the pandemic, we saw a couple factors emerge. One would be nearshoring and reshoring being the other. What does that mean? We couldn't rely on goods to come from China to the United States or Canada. So what was just-in-time inventory is now going to become just-in-case inventory. So we think inventory restocking is going to be a big tailwind for this sector going forward, as will bringing manufacturing back onshore in North America. So you put that together, Granite was already well-positioned with a low-levered balance sheet. They focus on industrial warehouse in Canada, the United States, and Europe. And with that capacity on their balance sheet, they're able to acquire assets attractively and accretively. We think Granite's really well positioned to take advantage of this theme of industrial warehouse. So it's a stock we continue to own, and continues to do well.
Okay, we are going to jump. We're going to take a break. Andrew Moffs is taking your questions today on real estate stocks and REITs. 1-855-326-6266. Chad in Vancouver. Go ahead, please.
Hi, Andy. First-time caller, big fan of the show.
Good.
Andrew, I'd like your opinion on WIR.UN, please, and long-term outlook. Thank you.
Great. So we're very bullish on WIR. It trades both in Canadian and U.S. dollars. I think about it in U.S. dollars because it operates solely in the United States. This is an interesting stock because it falls in that group of Canadian REITs listed on the Toronto Stock Exchange that exclusively owns U.S. assets. And time again, what we find at Vision is that there's an arbitrage there, meaning Canadian investors don't value these stocks appropriately, and U.S. investors don't typically come north of the border to buy U.S. real estate exposure. As a result, you have one of the most inexpensive industrial warehouse REITs listed in North America in WPT. This stock trades, in U.S. dollar terms, in the $17 range. It's worth north of $20 at least near term, when you just look at comparable transactions in the private market. And then you asked about the long-term outlook. I mean, I gave a little bit of color when I talked about Granite REIT earlier. We think that we're in the early innings of the industrial warehouse cycle. Many of the forces that have, if you think about e-commerce as a percentage of retail sales, that's only been accelerated because of the pandemic in terms of adoption of e-commerce, whether it's even on the grocery side. You think about the cold storage side, there's so many different reasons why the supply chain is moving more and more towards warehouse and delivery, and companies like WPT are going to benefit. What we also like about WPT is that they have a growing fee income stream where they've partnered with some of the world's largest pensions in order to grow that. And so they're taking advantage of all the different industrial warehouse opportunities that are coming their way across the United States with multiple ways of raising capital to do so. So long story short, we'd continue to own and buy WPT here.
Do you think we will see a future in which some malls are simply converted to warehouses for e-commerce?
Certainly, I mean, that's the desire. Well, the challenge is always municipalities allowing that use. And it's not always as simple as you hope. You think about just simple things like when a truck comes in and needs a certain type of turning radius, will the mall be able to afford it? Does the mall owner own all the footprint around it? Meaning, typically what you find is a department store owns this land and it also owns the surrounding parking lot. So you have a lot of, stakeholders at play when you want to do something like a mall, because typically the mall is well located. So, that play makes a lot of sense. It costs a lot of money to retrofit, and you need a lot of public support in order to do so. But more and more, that is a trend that will occur for sure.
You made parking. I mean, it's interesting. People who are critical of cars, or what they say is an overdependence on cars, say that parking is enormously subsidized. It is interesting. It's a valuable commodity, isn't it, parking? And the pricing is often obscured.
Absolutely. Parking's generally speaking a land bank. And what the higher and better use of that land changes over time, and all that matters is that land in an area where it's all about demand and supply. And if land is dear, then sure, that parking is going to be worth a lot more, and people don't necessarily factor it in when they think about it. The opposite is also true. We've seen through the pandemic, many of the office REITs, their net operating income has been severely depressed. And why is that? They've lost all that parking income. So it goes both ways, but it certainly is a store of value where there is a higher and better use for the land.
Yeah, it's a fascinating story. What is going to happen as some people anyway, move away from owning cars? They might just rent them or Uber. Rohit in Brampton, Ontario. Go ahead, Rohit.
Yes, I'd like Andrew's opinion on Nexus Real Estate Investment Trust. Thank you.
Thank you.
Yeah, so Nexus is a good little company. I'd say about 2/3 of its asset base is in the industrial warehouse space in Canada. The balance is evenly split between office and retail. Those are more challenged sectors that we typically avoid. The good news is, at least on the retail side, it's more focused geographically speaking in the Quebec marketplace. And if they wanted to sell those, you could try and focus on a specific buyer for that. We'd like the stock more if it was 100% industrial, quite frankly. They've done a good job of growing that portfolio, and they continue to do so. They've been very creative in terms of growing externally, meaning they're finding off-market opportunities with a vendor who's willing to take back units in Nexus REIT to help grow the market cap. So generally speaking, good company, well-run, very safe yield, and growing slowly but surely. And if they could just become more focused on industrial, I think the market would definitely reward it more. But if you own it, I would continue to hold it.
Paul in Toronto, fire ahead, please.
Hey, Andrew. Quick question for you. I just wanted to touch base on another potential industrial REIT, Parkit. I know they're converting to buying up a lot of industrial locations right now. Wanted to get your thoughts on Parkit. I know they have a great management staff as well.
Thanks.
Yeah, so that's correct. Yeah, but Parkit is sponsored by Stephen Scott, who many investors know as the head of Storage Vault, a stock that we own, and ticker SVI, that's focused on the self-storage sector. And he's done a great job of continuing to grow that company out of his private company, Access. Similar playbook as Storage Vault Parkit, ticker PKT. He is vending in assets from his private company Access, as well as trying to grow externally and focus on industrial to be yet another player here in Canada. It's a nascent company. It's in the early stages of growth. It's hard to, I'm always one for analyzing earnings and looking at the internal growth of the company. It's not much to analyze here other than a good sponsor, good asset class. Stock by any stretch is trading above its net asset value, which is a good thing if you want to grow, because he can now go out and use his units to grow creatively. So that's the short story on Parkit. We'll see how the growth story emerges, but certainly focus on the right asset class with a good sponsor.
Okay, let's take a break. Andrew Moffs is taking your questions on real estate stocks and REITs. 1-855-326-6266. We've got Dave in Stony Plain. Go ahead, please.
Hi, I wondered if we could get your opinion on American Hotel Income Properties, symbol is HOT. Bought it a long time ago, and I'm in a negative position, and I just wondered if there's some hope for it, or should a guy just move on, take my losses? Anyway, thanks for taking my call. Great show, guys.
Yeah, so it's a great question. On the topic of hope, I mean, hotels have been the hope trade. Meaning, hotels are typically the first sector to go down in the downturn and always the first one to come out. And of course, that's because, it's really going to capture inflation and capture the business cycle as GDP growth increases. And the problem, of course, today is there's zero visibility. We don't know when the business traveler is going to go back out on the road, when group meetings will reoccur and conventions, et cetera. So that's a bit of the hope trade, generally speaking, in hotels. American Hotel Trust, which owns exclusively U.S. assets listed on the TSX. This stock has been a tough one to own. I'd probably move on from it today. They did get a lifeline earlier this year where a couple of private investors injected some capital into the REIT in a preferred equity investment, which was a positive because it gave them the cash they needed. The negative, of course, is that it was highly dilutive. So as a result, the stock only trades at about a 5% discount to its net asset value in a sector without a great outlook. I'd probably recommend, if you have a loss, why not crystallize it, look for something that has more growth, unless you want to stay in this and, you believe in that trade and, it's high risk, high return kind of scenario. That's kind of how I view the hotel trade today. If you're going to invest in it, which we do, we typically do it in bigger sponsors, bigger REITs, which have more diversified portfolios and more, for example, Pebblebrook Hotels in the United States, ticker PEB. They're more focused on leisure hotels, and that, of course, we've actually seen values sustain themselves throughout the pandemics, and then so those are more of the plays I'd look to focus to, as opposed to some of the limited service hotels.
Okay. We have Jack calling from Calgary. Go ahead, please.
Oh, hi. Thank you very much for taking my call. Excellent program. My question is today on RioCan. But I have more of a general question, when you receive your distributions from, your different REITs or whatever it is, you can get like interest income, you can get a capital gains, etc. And then there's one there too that they always call it a return of capital. It always seems that the prescribed rate of return is always bigger than what the actual return in cash. But in the end, you're always developing your cost base, and you're wondering, okay, I'm getting these distributions, but I'm actually getting paid my own money, but I'm setting myself up for a capital gain down the road on it. I'll hang up and listen to your comments. Thank you very much.
Thank you.
Sure. I mean, that's a fair assessment of the distribution. Some investors really like the idea they don't have to pay taxes in any given year because with that return of capital, but eventually one does have to pay taxes. Hence, at Vision, ironically, we focus very little on the distribution as a percentage of the total return. We really just care about the total return. What's going to be the actual return of the asset? So, meaning if net asset value is going to increase over time, yeah, the distributions will follow. But really, we care about intrinsic value increasing because the share price will probably follow suit. RioCan, if that's a specific question here, generally speaking, a stock we like, great management. They are in the retail space, which is a sector we've typically avoided. What we like about RioCan is that they, the valuation was such that the market wasn't giving it enough credit for a bit of the resiliency of its portfolio. They have a growing multifamily portfolio, and their, a lot of their intensification it will be rewarded over time once those new projects get delivered. So we like RioCan. If you own it, I'd continue to hold on to it. And in terms of the distribution, it's part of the puzzle. I think in RioCan's case, it's about a 4.5% yield, which is a decent distribution, but not nearly as high as some of the other REITs. And so again, you want to look at that REIT on a total return basis as opposed to just the distribution.
Kevin is calling from Windsor, Ontario. Kevin, you're on the air.
Cominar REIT, buy, sell, or hold. Incidentally, I haven't seen that binge on from Contra the Herd in quite some time. I don't know why he's not on, but if you've got some rule keeping him off, break the rules. Rules are made to be broken. Thank you.
The reason is on Market Call, we've cut back on newsletter editors and newsletter writers. We're going more for people, portfolio managers. But I miss Benj. He's a great character. Anyway, Cominar, Andrew, please.
No problem at all. Cominar, I don't know if I'd be buying it here. It's been going through a strategic process for quite a while now. It's a diversified REIT, primarily focused on the Quebec market. Its office assets and retail assets primarily are going to be challenged coming out of the pandemic, whereas one might have been a bit bullish on the prospects of monetizing some of those assets, in the beginning of last year. Fast forward to today, I don't know if those values will be there, particularly on their enclosed mall side. If I'd own it, I'd probably move on.
Okay, we are going to take a break, and we're going to have a look at the top picks from Andrew Moffs right after this. For your first top pick, Andrew, you're sticking with Tricon Residential. Just remind us what your number one reason for liking them is.
The valuation. So this is a company focused on single-family rentals in the U.S. Sunbelt. Simply put, you look at housing prices today. I take a third party like John Burns. That firm is forecasting 10% home price appreciation in the United States in 2021. You apply those metrics to Tricon that's already trading at a discount to net asset value. You have a stock that can easily be north of $15. The stock was trading as high as about $13.73. They recently raised equity at $13 to help continue their expansion in the single-family rental space. So the stock's been temporarily depressed, so we think there's no reason why it shouldn't get back to the levels it was trading at just a month ago, let alone a big runway in the housing space. There's two ways to look at single-family rentals. I talked about the value per home, but you could also look at the income basis, the cap rate. It's trading probably north of a 5% cap rate. If I put a 4 3/4 cap rate on this company, where it is at a $15 stock, so we're very bullish on Tricon.
Okay, so you got your case there, and it is interesting how they've tightened up their portfolio, changed it. Dream Industrial REIT, another builder of these warehouses for e-commerce, or that's part of their suite of assets.
Yeah, so Dream Industrial is growing nicely. They focus similar to Granite in Europe, in Canada, and in the United States. Dream Industrial just announced a very interesting transaction where they're going to grow their portfolio in Europe significantly, and the portfolio now will become somewhere between 35 and 40% of the company, making it the best play on European warehouse that you can buy in North America through a publicly traded company. We think e-commerce is early in Europe. The rents are certainly affordable relative to where rents are in Canada, yet you have the same setup in terms of a tailwind for warehouse space over there. And then if you think about the rest of Dream Industrial, 50% of the portfolio is in Canada. Its biggest markets are Toronto, Montreal. Toronto had, 15, 20% rent growth last year, another 10, 12% forecasted this year. The setup is really great for this REIT. We think it's well situated. The stock price is it's similar to Tricon. They just did an equity offering to fund that potential European acquisition. So the stock's been temporarily depressed. We think here's a nice opportunity to watch the stock grow back into the $14 range, and we think fair value is north of 15. So we're bullish on Dream Industrial as one of our top picks.
Your next idea is First Capital.
Yeah, so, if you've listened to us at Vision for a while, we've tended to avoid the retail space, generally speaking, but we are bullish on necessity-based shopping, and that's what First Capital provides. Its shopping centers either have a grocery component or a drugstore component or a liquor component, all types of uses that continue to do well throughout the pandemic. The stock has been depressed. That's because cash flows did come off throughout the pandemic, but not to levels of other retail REITs. They did have to cut the distribution, but therein we see a big opportunity. In fact, when they cut the distribution, they said in 2 years, it seemed like a temporary cut, because within 2 years, they're most likely going to have to increase it again because cash flow requirements will dictate that they'll have to pay out that cash flow. Here's a stock trading in the mid $17 range. IFRS values are north of $22. So big discount to net asset value at a time where, that asset class in the private market is continuing to trade at a premium to where it was pre-pandemic. So we like management, we like the stock, we like the setup here again. So we think you'll be rewarded buying a stock despite being in the retail sector at a discount to net asset value.
Andrew, we'll have to leave it there. Thank you very much indeed for joining us.
Thanks for having me on. Always a pleasure.
Andrew Moffs of Vision Capital. Let's see how the markets have been trading today.